You will finally understand smart money concepts after watching this, if you don't already. I want to simplify it as much as possible so even a 10-year-old child can fully grasp these concepts. This is the best kept secret in trading. Most strategies are retail based. If you're watching this video and don't know about smart money, you're in for a real surprise. This is what we're going to be covering in this lesson today to put the SMC puzzle together for you. Lesson number 1, market structure. This is one of the most important aspects of smart money trading and trading in general, and it will improve your trading tremendously. In this lesson, I'll be going over different structural breaks so you can understand price action and be able to know what is happening in the market and time your entries more perfectly. There are 3 basic movements the market makes: uptrend, downtrend, and ranging. Each is made up of 4 different swing points: higher high, higher low, lower high, and lower low. Here's an example of an uptrend. We get this break in structure to the upside, which shows that the buyers are in control and that there's more demand in the market. In a ranging market, we're getting equal highs and equal lows, where there's no direction in the market. It's just moving sideways, but this is excellent for range trading. And then we've got the downtrend, when we get these break in structures to the downside, showing that the sellers are in control and that there's more supply in the market. These are the swing points. As you can see, this is the higher high, and this is a lower high because it's lower than the higher high, and this is a lower low. These swing points help us understand how the market is moving and the balance between supply and demand. Very easy little components to become aware of when you're observing the chart and making your trading decisions. Here we have an uptrend with continuous break in structures to the upside. On the opposite side, downtrend with continuous break in structures to the downside. And then a ranging market is when we have these equal highs and equal lows, where there's no real break in structures up or down, just sideways moving market. Understanding these market movements is all about understanding the swing points on the chart. You want to focus on break-in structures to find perfect trading opportunities. You can understand where the buyers and sellers are gaining strength or weakness. There are 2 types of structural breaks to become aware of. Number 1, continuation breaks, and number 2, reversal breaks, which is what we call change in character. Here is the difference. So we get a set of higher highs and break in structures to the upside. So it's just showing a continuation. Then over here, we get these higher highs with these break in structures to the upside. Then all of a sudden, we get a change in character where the market actually shifts from a continuation into a reversal. This is where we get our first lower low. As you can see, price breaks this structure point. This is the first sign that a reversal is starting to happen. Understanding this market structure will really open your eyes to be able to look at the chart and automatically understand what is actually going on. We get these break in structures, which is the continuation. Then all of a sudden we get this break in structure, breaking this main trend line over here. This is what we call the change in character. And usually this break leaves behind a supply zone. This would be our entry. Lesson number 2, order blocks. These help us determine precise entry points. These are visible places on the chart where large orders are resting. These usually occur in zones near imbalances and fair value gaps. We see displacement in the market, and before the displacement occurred with this impulsive move, we call it an order block. But they are just essentially supply and demand zones on your chart. Bullish order blocks are called demand zones, and it's usually the last down candle before an up move, whereas bearish order blocks are called supply zones, and these are usually the last up candle before the down move. Ensuring when these candles are indecision candles, I find those give a higher probability of success. And I always look to mark out the indecision candle. Here's a bearish order block. So we get this break in structure. We mark out break in structure with this massive move of displacements. We mark out the indecision candle. This becomes our zone. Then we get another break in structure. Leaves behind another indecision candle. We mark it out. Becomes another zone. So we want to look for break in structures accompanied with displacements, and we look at the move that happened before the displacement. We look for that indecision candle before this momentum. Bullish order block is our demand zone. Same thing, we get this break in structure, change of character, leaves behind an order block, indecision candle, which is the last down candle before this up move. We mark it out. Price respects it perfectly. Before we go any further, if you haven't already, check out my new course. We're going to more advanced concepts of smart money trading. Lesson number 3, market inefficiency or imbalances. They're also known as fair value gaps. All of these terms, however, refer to the same idea. But to put it simply, market inefficiency occurs when a large order is placed in the markets and it creates this gap between the wicks, almost like an empty space where the market maker was not able to fill all of their orders. So we call this an inefficient market. Price usually likes to come back to this place to fill in these orders and close the gap to make it an efficient market. Here's an example. Price moves with velocity up and it creates this gap between the wicks. This is an inefficient market or an imbalance or fair value gap. These become excellent targets or entry points. On the other hand, we've got the efficient, where you can see the wicks close the gap, which is an efficient market. Why is it important to distinguish between this efficient and inefficient market structure? It tells us a few things. It shows us that price is giving both buyers and sellers a fair chance in accessing liquidity. And we can expect price to come back into these zones and fill them in, giving us this opportunity to liquidate the market. If we find a region of imbalance, we can expect price to pull back into that area and then continue to move in the direction that it was intended to move into. Keep in mind, though, that this doesn't always mean every single imbalance will get filled. Here is an example. We get this massive change of character break in structure, leaves behind a zone and an imbalance. These become our targets and entry points. You can see over here, price pulls back, taps into the imbalance before continuing its move to the upside. Here's some more examples. Price breaks structure, leaves behind this imbalance over here. We mark it out. Price comes back, taps into this area, and you can see bounces off this area and absolutely respects it. These are almost like pools of liquidity, just waiting. Here's a short example. Price breaks structure, leaves behind the imbalance. We mark it out. Where we've got an imbalance and an order block, it's almost magnetic to price. And we can watch and wait and look, take entries off these places. Lesson number 4, liquidity. Liquidity is just an area where stop losses are resting and pending orders. Essentially, we are all liquidity in the market. Popular areas where retail traders set their stop losses and pending orders at these levels are support and resistance levels, double tops, double bottoms, and trend lines. Since these are popular areas where retail traders tend to execute their trades, a lot of stop losses will be resting in these areas, making it a nice level of liquidity for market makers to target. As you can see, we've got this double top. Retailers would enter a short position here and they would have their stop losses resting over here. In this bullish trend, they would enter a long position here. Stop losses would be under the low swing point. And at the support level, the same story. So essentially, these stop loss levels become excellent places to look for entries, because the banks need mass amounts of liquidity to fill their positions, and they target these stop loss levels as entry points. Trendline liquidity. Most retail traders would enter a short position at this trend line over here, but majority of the time it will break above the trend line and it will liquidate them. Only then it will move in the direction they thought it was going to go into, essentially faking them out and causing a liquidity sweep. It's always good to become aware that this happens a lot in the market. You can see we've got these equal lows over here, and retail traders would have looked to take a long position over here. I mean, why not? Price is respecting this zone. Then all of a sudden, price breaks through there, liquidates all these people who are looking to go long, gathering liquidity, and then turning around and moving in that direction. Equal high liquidity. Another example. Price bounces off the zone, 3 times bouncing off the zone. So we can assume it's going to happen again. The retail traders will look to take a short entry at this point. Then what happens? It breaks through, taps into all their stop losses, liquidates them all, and then turns around and goes in the intended direction, essentially tricking the market. Lesson number 5, supply and demand. Supply is an area of selling and demand is an area of buying. And these are just more examples of liquidity areas where we have lots of orders pending and waiting. Here's a nice little story if you want to pause and read, and it continues here if you would like to pause and carry on reading. There are 2 types of supply and demand zones: reversal and continuation zones. These include a rally where the buyers exceed the sellers, a base where the sellers and buyers are equal, and a drop where the sellers exceed the buyers. Continuation zones is when a price moves in one direction, consolidates, and then continues to move in that direction. Price rallies, bases, and rallies again. And with the supply zone, it drops, bases, and drops again. Another example, rally, base, rally. This continuation of movement. Drop, base, drop, tap into the supply zone and continue to drop, continuing to move on a downtrend. With reversal zones, these are formed when price reverses and sets off onto a new swing. With supply zones, we get this rally, base, and drop. With demand zones, we get this drop, base, and rally. Price rallies up, consolidates into this base, and drops. Price drops, finds a base, and then rallies. The secret that I talk about all the time is indecision candles. I frequently draw out my zones based on indecision candles as a reference point. It's this place in the market where the buyers and the sellers equalize, resulting in a candle like this. Small body with long wicks, or big body with small wicks, or big body with no wicks at all. Indecision candles are usually followed by these breaks in structures and displacement, and when they are, they become excellent pinpoints for supply and demand zones. Lesson number 6, correctly locating your zones. How to know which are the best zones to actually select. You must learn about equilibrium, discount, and premium pricing levels. Equilibrium is the midpoint of a range, the equal of the range, where an asset is neither expensive nor cheap. And these aren't the best levels to execute a trade from. When executing our trades, we want to buy at cheap levels, which is below the equilibrium. And we call this discount pricing. And we'd want to be selling at more expensive levels, above the equilibrium. We call this premium pricing. As you can see, we got the swing high, swing low, premium, discount, and equilibrium. We're looking for sells in our premium pricing level, and we're looking for buys at the discount level. It makes sense. We want to get an asset when it's cheap. When we're going long, we want to get an asset when it's expensive, when we're going short. We can easily identify these levels using the Fibonacci tool, or you can train your eyes and you can just spot it quite easily. In this example, which demand zones would you look to take an entry? The zone that aligns with the 50, 70, or 80%. As you can see, the zone that was at the 50% equilibrium level did not hold, and price respected the discount level. This would have been perfect entry point for our trade. So we look for these places where our supply and demand zones link up with premium or discount levels. Another example, which one would we take a short off of? Would we enter here or here? Of course, we would enter at the premium level, which is aligned nicely with our 70 and 80% on the Fibonacci tool. As you can see, price broke completely through this equilibrium zone, but responded nicely off our premium level. Lesson number 7, the market cycle. Starting with contraction, the price progresses into expansion, retracement, and then the reversal phase. And this cycle repeats and repeats for all time. Elements to the market cycle. We've got this contraction, expansion, retracement, and reversal. Backtest your charts and you will start to see the repetition of this cycle over and over again. The price comes into our contraction phase and then breaks out of this phase with our expansion, retraces back to the supply zone to tap into it to get liquidity, and then reverses to continue in its intended direction. As you can see here, tapped into it, got liquidity, and reversed. So we got this contraction, expansion, retracement, and reversal. Another simplification of this cycle. Contraction, the first phase, we draw a box around it, we wait for price to expand out that box. We know expansion started. When it expands, it usually leaves behind inefficiencies and order blocks. We wait for price to come back and tap into these order block zones, which is the retracement. Reacts off of them, gets liquidity, and then continues to move in the reversal phase. By now, you should be an expert at smart money trading basics. If you enjoyed this video, consider watching more advanced videos of mine in my channel, and check out my course if you really want to deep dive into smart money trading concepts.